Okay, we're going to roll right into panel 3, which is on the emerging role of AI in finance. It's my pleasure to introduce the moderator, Samim Ghamami. Samim is currently the chief economist at the New York State Insurance Fund. Before that, he worked at the SEC, advising its leadership on reform of the Treasury market and other capital market initiatives. He is also an adjunct professor of finance at NYU. Samim's career has taken him across policy, markets, and academia with roles at the Federal Reserve, Treasury, Goldman Sachs, Millennium Management, Columbia, and Berkeley. Apropos of this panel, he is a member of the Bretton Woods Committee's Working Group on Artificial Intelligence and Finance, which has released reports such as Governing AI Across the Global Financial System. When not doing research and shaping policy at the intersection of macro and finance, you can sometimes find Samim in the dojo, sharpening his skills as a black belt in karate. Samim?
Thank you very much, Ramin and the SIEPR team for this great conference, and thank you very much for the invitation. Like Ramin mentioned, this third panel would be on the emerging role of AI in finance, and we have three excellent, well-known experts and speakers on the panel. I would just at the beginning mention that I'm expressing my personal views, not reflected by NYSE or any New York State government agency. Before I introduce our panelists briefly, I would just maybe mention that from my personal perspective, what worries me, I'm hugely optimistic about the potential of AI in general and its role in finance. What worries me a lot is till we go through this transition and find a way in the new steady state, the potential disruption and dislocation in the labor market, that's one aspect of it. The other aspect of it is I'm personally in the camp that I believe that in the near to medium term, AI would push nominal interest rates in the US higher than where they are right now. And finally, from the financial stability perspective, I personally think that AI governance and regulation would need to be really proactive and forward-looking. Now let me introduce our panelists. Michael Su was the acting controller of the currency from 2021 to 2025. He has held positions at the Federal Reserve Board, IMF, Treasury, and the SEC. Currently, he researches and writes about AI, advises a range of institutions, and is a fellow at the Aspen Institute and the Cambridge Judge Business School. Kristin Johnson served as a CFTC commissioner from 2022 to 2025. Prior to that, she was a tenured professor of law at Emory University and Tulane University. She's currently a tenured professor of law at George Washington University and a fellow at the Cambridge Judge School of Business. And Christopher Martin serves as a member of the leadership team of the Bank of New York AI Hub. He leads applied AI research in partnership with top universities, including the newly launched BNY AI Lab at Carnegie Mellon University. Prior to joining BNY, Chris was a founding member of the Bosch Center for AI and also held a faculty appointment at Carnegie Mellon University. Mike.
Okay. Thanks so much, Samim. So I thought I would spend a little bit of time just doing some table setting and then turn it over and we can get the conversation going. And just starting why is AI so different? Why do we need to care about this? And I think there's a lot of different answers to this. I thought I'd just start with these three. And the first is that with AI, the inputs and the outputs are very open-ended. This is very different. Right? It's different than a lot of technologies where you have to be a specialist to know how to use it. Here, anyone who can type can use it. And that really expands the world of people who can engage with the technology, for better and for worse. And then the outputs are also for a wide range of uses. It's not a single purpose calculator. A lot of the technologies that preceded were basically single purpose calculators. This is general purpose. Second, it's non-deterministic. It's hard to interpret. So it's unpredictable in good and bad ways. Invite anyone, just write the same question into any of these AIs, do it repeatedly 10 times, you're gonna get 10 different responses, no matter what you type in. And in some cases, that's good. That's part of what makes it valuable. Sometimes that can be bad. Interpretability is very hard, and it does not enable direct fixes. So, we all are familiar now, they've got billions of parameters. Some of the labs have figured out how to kind of see into those parameters. Even if you can do that, though, and there's a problem, there's a mistake, you can't use that to diagnose the fix for the thing that you want to get fixed. And that differentiates it from a lot of other technologies that are used. And of course, this presents a lot of novel accountability challenges. And this accountability issue we will come back to. And the third, it can take actions. It can actually do things. How many folks here have used a coding agent? Right, so it's quite a few folks, right? This is not just giving you a response. It will go out and do things for you. And interestingly, the more capable it is, the more automated it is, the more people slow it down. And I think this is really going to become an issue as the technology picks up and you hit the exponential where a lot of companies, enterprises want this to actually achieve a lot of things. Putting a human in the loop starts to create some frictions which are not necessarily helpful long term and can give a pretense of oversight. And the second is it can create feedback loops on its own. And so this, here in Silicon Valley, I don't have to say this, everyone talks about the exponential. They talk about that for both profits and for capabilities. People have talked about Mythos. And I think in the next year or so, you're going to hear this term RSI, recursive self-improvement. And that's basically models that help themselves improve themselves on their own. Now, why does any of this matter? This matters because the traditional infrastructure we use to trust and control things don't jive well with these features. And in banking, I had this experience sometime last year. I was talking to 3 different bankers about their uses of AI. And the first banker said, at our institution, we think of it as a model. So we put it under model risk management, and that's kind of the primary group that oversees it. Correct. Talk to the second banker. He's like, we think of it as software. It's like, it's like software, so we put it through our software development lifecycle. That's how we manage it. Talk to the third banker. He's like, this is a vendor product, right? We think of it, we put it through third-party risk management. That's how we. They were all talking about the same thing. And I think this really highlights that for bankers and for regulators, these risk management frameworks, that's the starting point. That's the framework. Those are the processes that you rely on to trust it. And effectively, we're shoehorning AI in different ways, whether it's a use case or whatnot. And I think recently, the federal banking agencies effectively repealed model risk management application towards AI. Personally, I think that's actually the right move because I don't think AI is a model. I don't think that framework actually is fit for purpose. It does leave a bit of a vacuum, though. And I think this does create an opportunity for both the industry and for players from, people like to talk about first principles, especially here in Silicon Valley. I would encourage everyone from first principles, what is the right risk management framework to approach this? And I think that's something we're all going to be struggling with and kind of working through on this panel and going forward. Thanks.
Thank you, Mike.
Thank you, Michael. Hi, good afternoon. Let's go through yours, I think.
Sorry,
to get
we have to
it's
slide
okay. I had to catch up there a little bit. Hi, good afternoon. We're standing between you guys and cocktails or beer and wine, whatever follows our panel. So I don't know how exciting I can be. On East Coast time, it's basically bedtime for me now. But I'm gonna really hard and try to share that a lot of what Michael described and what I anticipate Chris will share as well is that we're talking about innovation, a deeper integration of innovation, I think, than we've seen before in the history of financial markets. I think there is little doubt, little debate, little controversy that there will be, this period will be one of the most powerful and transformational periods in terms of financial markets because of the types of technologies that are being adopted and adapted. Earlier this year, I was in Davos at the World Economic Forum, and at that conference, in that space, the conversations among industry participants signaled that AI is expected to be part of a mega trend, a super cycle that will define certain aspects of financial markets for the next decade, if not longer. I'd highlight, in thinking about AI, and I think Michael's introduction perfectly did this, the slide that had sort of the three interpretations, or at least three iterations of how we've thought about what AI is in financial markets. I'd highlight that part of the challenge of really discussing AI involves understanding definitionally what we're talking about, its applications and its uses and the use cases. And I'd also highlight that, whether we're talking about machine learning, neural nets, a process that involves analysis through large language models, or generative or agentic AI, we're talking about an assemblage, I would argue, of technologies. And some date back as old as, I love to teach in class, biblical references or ancient Greek civilization references to iterations of this technology that existed well before crypto, as the previous panel described. But that will be equally important in the conversations around framing the regulatory framework and governance for crypto. So the slide I have posted for you really illustrates, I think, a use case and discussion that is worth having immediately in the context of how we govern or think about governance in the context of AI in financial markets and the potential risk management uses and concerns that AI integrates. So market participants have used diverse iterations of AI for decades in financial markets. Everything from credit underwriting to insurance underwriting. We could imagine investment advice, customer service, forecasting, compliance, all types of predictive and forecasting technologies and automation processes have been integrated with some elements or aspects of AI. These systems track and instantly process disparate data sets required for real-time engagement. One of the stages of engagement that's most important in our markets is trading. And so one of the things I'm really thoughtful about when we talk about AI is how AI is impacting trading markets. In the remaining 1 minute of my topper, I'm thoughtful about this, Ramin. In the remaining 1 minute of my topper, allow me to share with you 4 slides that I think illustrate both the potential and peril that could arise in the context of integrating AI in broader financial markets, but specifically in the use case of trading. Obviously, there's a potential to reduce costs, to reduce errors, and to achieve the promise of AI in many contexts with respect to efficiency. But misuse of AI by bad actors can exacerbate fragilities or vulnerabilities and lead to disruption, price inaccuracy, and market instability. So the slide you have before you illustrates something that none of you will be surprised by, and Governor Cook opened earlier today our entire conversation discussing. Where are oil futures prices? I don't know how often an entire audience or the entire country or world had been so deeply focused on oil futures prices, but there's very little debate and dispute today that oil futures prices are increasingly important in a number of contexts. Well, those contracts themselves are important, but I think trading in that market reveals something. So the slide that you have before you is a picture from June 2024 to March 2026 that reflects the average trading price for Brent crude oil futures. Brent crude oil is a sweet crude oil for those of you economists in the room that are ag-based or energy-based and have some familiarity with crude oil. But for those who don't, I'm going to share something that won't be hard to follow. I'd like to share in this second slide a little bit of an illustration of the same Brent crude oil futures contracts, but there's an emphasis indicating the exact trading price early March 2026. You'll see that the trading price on March 2nd, 2026 was something like $74.81 a barrel. Well, it won't take anyone in the room forecasting or predicting for us to figure out that by May of 2026, the price of oil per barrel has risen over $100. That's a very significant marker in the context of thinking about the global pricing for oil. But very specifically, something I'd like to highlight about that trading activity is the volume. The price told us something about what the global expectation regarding access to oil means, or how easily the supply and demand, where the supply and demand axes meet in light of how much crude oil is actually available in markets. The slide you're looking at here relates to trading volume for oil futures. So not the price per barrel, but the price specifically in the context of a derivatives contract that estimates how easily we will be able to access crude oil in the future. What I'd like for you to look at is, and it's kind of hard probably for you to see, but the very bottom on the axis that illustrates the date and time of trading, I'm illustrating 15 minutes of trading activity in oil futures markets. And what you'll note is at 7 a.m. or just before 7 a.m. on March 23rd, there was an exceptionally low volume of trading activity in crude oil markets. But something happened. There was an announcement by President Trump relating to the likelihood that the U.S. would launch a military campaign against Iranian infrastructure. And within moments, you see the market move radically and the volume of trading activity shifts. Well, that's very interesting. But even more interesting, and something AI has enabled regulators to detect, is the activity that occurs immediately prior to that announcement. There is a bump in trading volume that is difficult to explain. And what I would describe and suggest is that we've witnessed, not just in the context of this one announcement regarding trading, regarding military campaigns in the Middle East and the geopolitical conflict there, but in at least 4 instances, the Department of Justice, the SEC, and the CFTC have indicated that there are investigations afoot. Why? We've witnessed an unprecedented amount of well-timed, consequently highly suspicious market bets in traditional derivatives markets, products, specifically crude oil products, in light of the conflict in the Middle East. I'd like to use a little bit of this illustration later in the panel to talk about AI for good, AI used for bad, and describe some of the ways that both the market participants who are using AI have adapted or adopted AI for trading activity, but also how regulators are using the same technology to ferret out bad trades. I'll pause there and pass the baton to Chris.
Thank you, Kristin.
Thank you so much.
Thank you. Great. Thanks, everybody, for having me. You heard Carnegie Mellon in the intro. Hopefully it's still okay to be. Maybe that's maybe the other school that doesn't get names as well. But again, thanks very much for having me. So I just wanted to share a little bit, about the way that we think about this, at BNY. So, and also, I don't. Well, I kind of mean it for it to be a little bit of a BNY advertisement, but not really. But really, the point of this is that we've been doing this for a little while. I think we're kind of a little bit past this. But if you remember that MIT study at the end of MIT, so like when that came out, like 95% of firms are not realizing value from their AI investment. And we're in that, like, really? Like, we were really surprised by this. This slide here, we talk about AI being for everyone, everywhere, everything, and then that lower right-hand corner, deployed responsibly. This is really very much at the core of what we do every day at BNY. You don't take my word for it. Excuse me. You don't take my word for it. If you listen to the last earnings call, whether it's our CEO, Robin Vince, our CFO, talking about this, I bet you probably 2/3 of the earnings call had something to do with AI. And so again, the point is that we are really leaning into this transformational technology. And again, this is just a little bit. We'll run through this so that we can get into the discussion part of it. But when we say why are we in that 5%, is it's really taking hold throughout our entire firm. So whether it's in engineering and operations and legal compliance, et cetera, we're really doing our best, to deploy this, to identify the highest potential use cases, and also to deploy them at pace responsibly. I think what was really exciting to Governor Cook's remarks this afternoon, also East Coast time, earlier this afternoon were really fantastic. And I think a couple of things that she mentioned that I think really resonates with the way that we think about it. So number one is I thought very much she talked about how in her organization they're also experimenting and trying. Like there was that sense of urgency that I felt from her. Like, what does it mean for us? That's very much the way that we think about it. She also talked about sort of a change, there being a change in, right now, maybe most people are sort of seeing like a retasking, right, where AI is changing the way a task, but not quite the role. And we're actually now in that phase where we are seeing a change in role. So again, you can hear Robin talk about, our CEO Robin Vince talking about, our digital employees that we have at the firm. And now this is also changing the way that people are doing their daily work. For example, digital employees are managed by human employees. And you look at, especially our colleagues in operations, people who never had who never saw themselves or saw a path to be a manager, now they are managing digital employees or agents. sort of superpowered agents. So this is also now, it's already taking place where it's not just we're iterating, when these smaller pools, we're also iterating in these large things. And this is only possible, and maybe this is a good segue into the discussion here. So we have our enterprise AI platform. It's called ELIZA, and ELIZA allows us to do amazing things. That being said, is kind of the unheralded superpower of BNY is our colleagues across the first, second, third line of defense, who now, since we launched 3 years ago, it's from data ethics, legal, information, the whole compliance. First and second line, and it's really these men and women that have leveled up their games incredibly in the last couple of years that allow us to ask better questions, better answers, push us in the right direction. So when we say we want to do all this responsibly, we're right at. I think we're given the engineering capacity of the company, we're able to innovate at pace really remarkably, and it's these men and women that we work with, and it's those guys I think are the superpower that allow us to go where we want. Responsibly, and I think that's really a big key to victory. I think sometimes it gets overlooked when we're building these things.
Thank you, Chris. So I'll first ask one or two questions with regard to your opening remarks, then we can further discuss what we discussed offline last week. So Mike, if you can maybe elaborate a little bit more on the newly issued guidance on model risk management by the FDIC, OCC, and the Fed.
Sure.
You mentioned that the fact that AI hadn't been mentioned, that's not a good sign, or that might be a good sign. So if at some point the guidance on MRM will capture AI, do you think, that would be feasible given the opaqueness of some of the AI models? Yeah.
So model risk management, like the history of model risk management is if you go back to late 90s, early 2000s, as banks were using models more and more for valuation, for risk, for capital, et cetera, the regulators are like, okay, there should be some controls around this. And what should those controls be focused on? It was largely validation focused, okay? So think of model risk management as you're at a bank and you want to use a model. That model has to get blessed before you can use it. And that blessing takes place where you have a lot of very smart people who basically kick the tires on the model. Is there documentation? Is there a purpose to it? Are the data feeds? Are there all sorts of unit tests, et cetera? And then once they test and kick the tires, they say, great, it can now be used. That process does not work for AI because every single query you put into AI is like a whole new thing. And so how would you subject AI, an LLM or an AI system, to a model review process? Now, a lot of banks said, okay, we won't do it literally. We'll kind of do it figuratively, right? We'll kind of take the concepts of model risk management and just kind of shoehorn it into a process that we feel is controlled. And in the beginning, that was fine. But now that you have agents that can do lots and lots of different tasks and lots of different things, I think the federal banking agencies were wise to say, okay, we're not going to try to force banks to put a square peg into a round hole. We're just going to say MRM doesn't apply to Gen AI and to agentic systems. We will issue a request for information and try to do this from first principles later. So that's where we are currently today. And it'd be interesting to hear from Christopher, but I'm sure banks have taken a lot of different approaches to this. What's interesting now is that there is no guidance. So in some ways, the banks are like, wait a second, what am I supposed to do now? And I think that this is, again, I think it's an opportunity to really say, well, what are the controls that are being in place that make you as a bank comfortable that you're deploying these things in a responsible manner?
Yeah, and I think that's, I was remiss too in we mentioned earlier about our first, second, third line partners. Also, incredibly robust discussions with our regulatory partners as well. I have to admit, so in kind of my previous right now I'm a little bit more of a research role now, but my previous role at BNY in responsible AI, operationally, right, you have to, the exercise is, for those of you that have done this before, you go before, our colleagues with the FRB and you say, and they can literally pick any model in the inventory and say, tell me about this. How do you know it works? Or whatever it is. I'm going into these, and I'm not really that nervous of a person, but I'm like, I think just because of exactly what you're mentioning. So the point is, these conversations that we've had over the last couple of years, I hope I hope they would say the same thing to us. Is it's really been a constructive discussion. I mean, that was just the world's worst pattern matching example ever. Like model risk management, large language model. Like, right? Are you kidding me? And so this was again. We're now, I think it's what the stuff that we hope to do together with whether it's academic or research partners or otherwise is we want to raise the game for everybody, right? So for example, the work that we're doing with Carnegie Mellon and others, it's we were talking a little bit beforehand, is there's an opportunity for us to take advantage of it, but really we want to have this research contribute to the increased stabilization of the entire financial services sector, such that we all can deploy this more effectively.
So one of the discussions that at least I've had with Bretton Woods AI working group has been whether it makes sense to classify different use cases of AI in finance and see which one would be safer or which one would need more of that human in the loop component. So for example, in trading, it might be riskier. In compliance and risk management practices, it might be safer. Do you have that type of classification at Bank of New York Mellon?
Yeah, I think there's not a simple. We were talking earlier again about kind of a taxonomy, right? So right. How do you understand, quantify, control the risk? Is it for what are you using it for? Is capital, liquidity, lending? What's the scope of this? How many people are used? Like if it does involve, what's the volume associated with this? And we've actually started to publish, some work. I think it came out at the end of last year at one of the a workshop associated with one of the leading academic conferences. NeurIPS end of last year will also be present again this year in Australia. That will not be too bad. So we're increasingly trying to tell our version out there and put these kind of these. Our approach, to risk, our understanding, let's work on this, together. So there's, but it's certainly not just one dimension, right? There's a lot of complexity to bring out of this.
Can I hop in there? Largely because this is like the definitional issue, the taxonomy issue, and I think Michael hinted at it in his opening comments as well. The reality is, to be quite honest, as a regulator, what I was most surprised by, and as a lawyer, with many years' experience as a lawyer and a tremendous depth of commitment to understanding the statutory framework that establishes the jurisdiction for the various regulators that oversee parts of financial markets, the limitations on our ability to solicit and receive information regarding how the private sector is integrating AI. And I don't mean this in any way as an accusatory point. I just think it's a reality of how our supervisory engagement with some businesses work. And I think to Samim's point, the taxonomy question of where risk management concerns are most heightened, if you will, in the context of AI integration is something that as a regulator, I thought it really important that we talk to regulated market participants about, right? So how do we typically approach supervision? We typically approach supervision from the perspective in terms of the overall licensed entity, from the perspective of an annual system safeguards exam. To Michael's point, there might be a model risk management sort of analysis. We're thinking about how you're valuing capital, liquidity. There are certain types of, I think, standardized approaches to how we as regulators engage with regulated market participants. But one of the issues that's sort of come up, a gap, if you will, in sort of approaching this integration of technology into financial markets is we don't really have an open-ended, free range sort of like, so tell us about how you're using AI in this context or that context, where we have mechanisms of raising those questions in the context of existing examinations, but it's not nearly as sort of as open of a dialogue as I think it should be. And to be quite honest, I have found engaging with banks and other financial institutions that there is a willingness and interest in having a pretty open dialogue about where AI is being integrated and what the exposure, what the vulnerability or fragilities might be as a result of integrating AI into specific operational infrastructure, right? And so I think there's a need for that dialogue, a very desperate need for that dialogue between regulated entities and their regulators. I also think there's a desperate need for the dialogue across regulators that oversee financial markets. And I'll leave it at that because I think you may have a question or two down the pipeline, but just sort of the taxonomy question, I think, is a great question for open dialogue in this particular moment.
Thank you,
Just
Kristin.
one other thing I would add. So within a given use case, the level of autonomy really matters a lot, right? So if you're going to use, if you can say a consumer service agent, a KYC agent, a coding agent, you can set it at the lowest level, which is just you type in a question, it gives you a response. The risk with that is quite low. That's different than saying arming that agent with the capability to go do something, which is different than arming that agent with the capability to spawn other agents to do something for a week. And those are all the same use case, ostensibly. And so if you look in, Christopher and I were talking about, like in automotive, you've got 5, 6 different levels of autonomous levels of driving. And there's agreement on what those levels entail, what the controls around each of those levels are, what the expectations, what the legal liabilities, et cetera. We don't have that yet for AI. That we are going to need at some point. And I think one of the parts that's both interesting and challenging right now, every bank, every financial institution, every non-bank, every fintech, they're all doing it differently. I've been really trying to see if there's convergence on this. There's not. And I think this is going to take a little bit of time to kind of work through with both the deployers and with the labs.
Thank you, Mike.
One more tiny risk management point that grows naturally, I think, out of what Michael just described is, and one of his earlier comments as well, the reality that for some financial institutions, AI is acquired and not proprietary. And I think to Michael's point, while everyone may be using AI differently, in some contexts, we have a convergence on the use of particular providers. Here's an example that's at least tangential, cloud service providers. When we think about critical third-party service providers for the financial services industry, it is absolutely clear that there are basically 3 large providers, and the 3 large providers dominate cloud service provision for most large financial institutions, most financial market participants. And so as a result, when we think about the potential for AI to be disruptive, one of the challenges that arises is concentration in the provision of AI services in a variety of contexts. I'm using cloud service providers, but we could also talk about trading software or algorithmic trading, capacity or facility. All of this leaves us vulnerable as a broader market creates, as Governor Cook mentioned in her opening remarks, some need to be thoughtful about the implications or potential consequences on financial market stability or financial market integrity more broadly. The potential, and she didn't say, I don't want to put any words in her mouth, I'll say explicitly for myself, systemic risk implications that might arise as a result of the concentration among the vendors providing really essential or essential services, increasingly essential services for some of the larger financial market participants. So even if JP Morgan or Goldman Sachs has developed their own proprietary system and has significant control, disruption among small and medium-sized enterprises in the banking or financial markets or securities or derivatives trading spaces, that can be pretty disruptive. We've seen it already transpire very recently. I will acknowledge during my term as a commissioner, we sort of quickly hurried to address what was a fairly significant market disruption that prevented our ability to publish pricing on pretty critical assets when a third-party service provider went down. So I think that discussion among market participants and regulators is really due for a rich dialogue.
Thank you, Kristin. Maybe one question for Chris. So given BNY's critical role in clearing, settlement, collateral management, if possible, can you elaborate on those type of use cases of AI at BNY? That would be very interesting.
Sure. I mean, to take a good one, we talk about onboarding. KYC, is a good example of something that's obviously a regulated activity, and this is the type of thing where still traditionally can be very human intensive, and a lot of something now where we talk about a good candidate for our digital employees or agents. This is on one hand it's a pretty clear set of instructions. Go look up this number, go figure this out, whatever. But of course with sanctions there's a lot of ambiguity can be introduced into that. And so now we have agents and digital employees that assist with that and can bring down the time to onboard a client pretty significantly. And that's good for everybody. Similar kind of thing with settling payments. For anybody that's ever read a Swift instruction, it's like unstructured, structured. Just everything. Oh, I'm just going to write everything in the optional field, kind of thing. And so this is again something that has to be it typically would be looked at by a human, or maybe there's a field that's missing, and really slows down the process for anybody. So by introducing agents and these digital employees, we view this as an opportunity to assist the system to introduce correctness. And also, I was talking with one of our partners, an advisor at BNY, is Professor Zico Coulter, and he used the phrase that, like, in many ways now, again, we have to work on also ensuring the output of this is correct. But he was talking about that you can really trust these output. But these processes, when you introduce things, they become an auditor's dream. Right, when done correctly. If I go and do this, like if I go and correct this Swift payment, why did I do it? I don't know. I guess but you're not going to stick probes into my brain and like pull out the neurons and stuff like this. And somehow this is kind of what we're. And by the way, this is when I say this is the kind of expectation we have on these LLMs, that we're going to go and like inspect them, which we are. The academic community is also very much looking into this, so I'm really interested in this. So the increased explainability that we have, but this gives us an opportunity to have actually increased auditability, increased explainability beyond what we would have with humans. That are you going to lie? Are you going to say? Are you going to be correct? No, I mean honestly, right? So all these kind of things. So this is an opportunity to bring a little bit more auditability into this. We believe also not just from a operational or efficiency perspective, but also from a stability perspective as well.
Thank you, Chris. So let's open it to the floor right now, and then
while you're finding, can I just respond really quickly to something Chris just said? And I had a slide that goes to this. This is sort of in our thoughtfulness as regulators about how we can use AI. I mentioned to you that sort of looking at this one slide, we can see there was a significant uptick in trading activity minutes before the President of the United States makes a really important announcement, and then global trading sort of erupts. I'd also point out, and I brought a slide that kind of describes this. I'll give you the snapshot even more quickly. We've used AI to identify cases where trading reflects spoofing in markets. It's a different kind of market manipulation and fraud that we are deeply thoughtful about in derivatives and securities markets. And what I'll just say in a nutshell is our ability to identify abnormal trading patterns without AI is deeply challenged, because the volume of data that we're meant to look at in any single day's use of trading, or single day's trading in a particular asset class, can be astronomical in terms of humans' ability to do this. And so something Chris just said that I think is really important, but also it's a little bit tricky, is this reality that some of the trading that happens in markets is happening through algorithmic bots. And those bots are sometimes just picking up on trends. If someone else starts trading while in possession of material non-public information, that person might be liable for insider trading. But the bots that start to trade because they see the activity happening in the market may or may not be. There may not be scienter or that actual human intent to engage in insider trading, and they may have no information, like many others who suddenly just hop on the bandwagon and start trading. So there are really interesting questions Michael mentioned earlier about legal accountability and responsibility that are going to be trickier once we get to a place where what we're looking at is a more substantial or greater percentage of algorithmic trading forces in markets than individual humans trading in markets, and a lot more difficult to deconstruct what the motivations were for some of the trades that might have taken place.
Thank you very much, Kristin.
Yeah.
So why don't we go to Daryl?
Okay, thank you. Michael and Kristin, you alluded to some of the systems risks that could come up when you give LLMs a pretty open-ended task. And recently, I'm sure everybody in the room has heard that the US government has asked the largest banks to have a look at Mythos and understand the degree to which it's a threat and act accordingly. But we haven't really heard anything about a plan. My understanding is that the threat is something like these systems, when given enough leash, are capable of, they want to solve the problem, and they're capable of getting into critical systems in the rest of the the enterprise. And some of the critical systems in banks, the largest banks, are pretty critical. And that would be true, for example, for the air traffic control system, for the electric power grid, and so on. So what is the plan, to the extent that you understand one? Is it to keep these dumbed down and not unleash their full capabilities? Is it to firewall them? What exactly is the government, and what are they talking about as far as a defense against these risks that doesn't take down AI in general?
So maybe I'll start. So just full disclosure, I am advising Anthropic, but everything I'm going to say here is basically based on public information. I do encourage everyone to read the Mythos model card. It's really long, it's 200 some pages, but it's actually kind of a page turner. But they describe some of this stuff in there and in some of their public statements. I think at the end of the day, like big picture, there are defenders and there are attackers. And what's happened is that the attackers, to do some of these hacks, it's pretty labor intensive to do some of these hacks. But with some of these new models, it becomes very, very easy. And that's the problem, is that the distance and the effort required to do some of these hacks is now shrunk. And so the plan, as Anthropic has explained, is to give the defenders a lead time to build some defenses to those attacks, recognizing the attacks are going to come. Like, this is not something that you can't put the genie back in the bottle and just say this is going to go away. It's going to come. And so the idea is just get one step ahead for critical infrastructure, start there. Now, it was, I think there's been a lot of debate, like how did they pick? Don't ask me, I don't know. But this idea of that, and the more people you give it to, the faster the attackers will eventually get it. I think that's these are the trade-offs. And so I think we are feeling our way through a policy of what do you do when you've got an extra powerful model that, can you give it to the good guys first, give them a head start, and then the bad guys will get it at some point. And at some point, it's going to get open source. These open weight models basically are 6 months behind. They're not very far behind. And so it's the game of cat and mouse that's been accelerated, I think is one way to think about it.
The other part of this too, so we were also part of the preview evaluation period as well. And it does kind of flip a little bit of the traditional risk posture on its head. Right? At what point does not acting, traditionally you just you're hanging out, you're fine, right? You're just gonna wait. Take a little while longer, it's fine. Now, attackers, you potentially have more capability than defenders. And so by not acting, you potentially introduce more risk than by acting. And so this is, again, the healthy, robust dialogue to have first, second, third line around this. And so it's an argument for more scrutiny, for more investment in this rather than less. Because whatever the analogy, Pandora's box, genie in the bottle, whatever, it's happening. And so let us be proactive in recognizing that there is a cost of inertia.
Thank you, Chris.
I think one of the things, they didn't build Mythos to be a hacking model. And yet, even despite that, it was really good at hacking. And so the concern is then a bad guy who gets it will be like, it will tell Mythos to make a hacking model that's even better than Mythos. And that's basically what the bad guys are going to do. So that to Chris's point, you can't stop that. So the only way is at best, you can try to get ahead of it a little bit.
So we have 5 minutes left. If there are other questions,
So this is Naresh here. So I have a question about, so we talked about, the Gen AI and agentic AI not being covered in, the model risk management framework in the US. So I think my question to the panel in general is that, I know that there are a lot of other frameworks that are available, like, the Monetary Authority of Singapore. So they have been doing a lot of work on, building a framework which is really focused on Gen AI, agentic AI, and third-party risk management as well. And, PRA in UK, so they have been doing some roundtables. So I would say outside of US, seems to be a lot of work going on understanding these risks and also trying to bring it into a guidance, if not regulation. So I think my question was, and also I think recently the US Treasury brought together some of the banks, and I think there was a voluntary risk management framework, for AI again, that focused on Gen AI also to some extent. So how are, what is the, what are the opportunities or challenges about banks, I think using these frameworks from outside, although, they may not be necessarily applicable in the US, I would say the US regulatory framework. Thank you.
May I answer also so I can apologize? So sorry, my phone is timed to ensure I know when I'm moving. I no longer have a staff. This is I guess, AI personal assistant, a variety of things. To respond to your question, though, directly, a couple of things. The first is the U.S. Treasury RFI was a fantastic endeavor, I think, at the close of the previous administration. And it really illustrates the point I was making earlier. I worked with Treasury on that RFI to help identify some of the questions and parameters for what we would like to ask industry. And we're having to ask because we don't stand with the authority to simply demand and guarantee receipt of every kind of information. There are authorities and powers for each of the financial market regulators, but there are also limitations on those powers, which is all appropriate and just. And in the context of AI, as we discussed earlier, different firms are using AI differently for different purposes in different ways. And all of that is information that's important to U.S. regulators. I think the Treasury RFI was a great jumping off point for a collaborative conversation across the Fed, FDIC, Treasury, the market regulators, SEC and CFTC. And I did a lot of work as a regulator bringing folks together in that context. Multiple events at Federal Reserve banks that I helped to organize that were intended to bring together diverse regulators across the financial markets to build what you were describing earlier, a framework of guiding principles for how to think about AI. Because we're seeing the Bank of England effectively execute on this, the Monetary Authority of Singapore executing effectively on this. I can't say if there's a current plan. As I exited the administration current, I don't know that I was being given direction or guidance or information about how we as U.S. regulators or even how international regulatory authorities might come together and talk about these issues. But I think it's important.
Thank you, Kristin.
There are a lot of frameworks now. So there was a while where there were no frameworks. And now there are like 1,000 frameworks. There's too many frameworks. This is really going to matter when something bad happens.
Yep.
I think in some ways, we have to wait for the incident, which will happen. And then we have to figure out what went right, what went wrong, who's responsible. We were joking earlier that there was a small company called Pocket OS. They were using Cursor. Cursor was based on the Anthropic's Opus 4.6 and using Railway. The CEO typed in an instruction and it wiped out the database of the company in 9 seconds. Mm-hmm. And that happened and they had no idea. Now, what if that had happened at a bank? I think that's a really interesting question to who's responsible? Would these frameworks have worked? It generates all sorts of questions about how are we managing this? Now, luckily, the banks are pretty conservative about how they're applying these things. And I think Chris said this guy was a bit of a naive.
A little bit, you get what you deserve.
Yes,
I mean,
yes.
I don't know what to tell you.
Yes. But to an expert, that's easy to understand. I think to kind of lay people, it's not so transparent. And I think that this is the thing we have to wrestle with now to try to figure out.
Just the last thing is, if I may take that is, you mentioned earlier, you talked to a bank, is it model risk, is it third-party vendor, or whatever. The answer at BNY is yes. Yes, and yes, right? And so joking aside, is we do everything we can together with all of the different risk domains to ensure that stuff doesn't happen. Again, quality conversations together with our FRB partners. Like when you deploy an agent, how do you make sure it's in its box? It only does well. All these kind of things. And so then we really want to be deploying things intentionally, and it takes a village kind of thing. I don't know what's all the analogies, but anyway, it takes a village, and the village is all of our risk and control and governance partners to make sure when we deploy these things to amazing effect, they're staying in the box, and we're doing everything.
Thank you,
I'm just terrified.
Thank you
Like
for
I
a
said,
great
we're
discussion.
Need that crazy event, that catastrophic event. Oh, terrifying.
Okay. Thank you very much. Thank you.